Good afternoon, everyone. Happy Friday and welcome to Weekly Commentaries. Markets are looking this week to resume their winning ways. After a pause and modest pullback last week, the S&P 500 is back on pace for roughly a 1% gain, while the Dow has climbed more than 2% and is again making record highs. Technology stocks, especially those tied to artificial intelligence, continue to lead markets higher. Now, while AI and tech remain the clear bright spots, the broader market still looks a bit more mixed and somewhat more fragile when you look underneath the surface. One of the more interesting and continuing trends we're seeing right now is that many large tech companies continue reporting earnings that are strong enough such that stock prices are rising even while valuations are declining. That doesn't mean volatility is disappearing anytime soon. In fact, it still amazes me how some of the largest companies in the world can experience a type of swings normally associated with small speculative companies. But make no mistake, these are not speculative businesses. These are companies generating enormous cash flow on revenues, the likes of which the world has never before seen. So despite the volatility, the longer-term trend continues to be upward. We did see a fairly significant pullback in technology beginning last October that accelerated once the Iran conflict began. But as I discussed at the time, those types of pullbacks are often healthy and normal. Markets rarely move straight up forever, and periodic corrections help reset sentiment and often create the foundation for the next sustainable move higher. And so far, that does appear to be what we are seeing right now. One example of how quickly the AI economy is growing is Anthropic. And although it's a privately held company and doesn't publicly report earnings, recent investor updates show explosive growth. Revenue reported reached nearly $5 billion in the first quarter of 26, and it's expected to more than double this quarter. The company is also expected, importantly, to become profitable very quickly despite their massive infrastructure spending. And that matters a lot because one of the biggest concerns investors initially had surrounding AI was whether these enormous capex expenditures and investments would ever generate meaningful returns. Well, now it appears a profitability timeline may arrive much sooner than many expected. At the same time, we're beginning to see some growing excitement around future IPOs, which are coming up pretty quickly, from companies like OpenAI, Anthropic, and SpaceX. Each of these companies is expected to come public at valuations north of $1 trillion. SpaceX alone has been discussed at valuations near $2 trillion. To put that into perspective, companies like Meta, Uber, Rivian, AT&T Wireless, all once viewed as enormous IPOs, they debuted at valuations under $80 billion. Naturally, this is leading to more discussion about market bubbles and comparisons to the dot-com era. I'm not going to spend a lot of time revisiting all the differences between today and the late 90s, I should say, but there is one major distinction worth repeating. Back then, valuations exploded higher based mostly on speculation. Today, it's based on current earnings growth, not hyped up future expectations that defied reality. Outside of technology, however, the broad economy is still facing challenges. Consumers are slowing, but importantly, they're not breaking. Now, retailers like Walmart, Target, and many grocery chains are beginning to report softer spending trends, particularly among lower income consumers. Walmart, for example, is seeing some of the biggest weakness at its gas stations as consumers continue dealing with higher gas prices. At the same time, employment remains resilient overall, and household liquidity is still historically strong. But cracks are beginning to emerge. Inflation is once again rising faster than wages, and credit card delinquencies continue inching higher. Low-income consumers are feeling increasingly squeezed, and much of that pressure continues to stem from higher oil prices and the inflation they create throughout the economy. The good news is that crude prices have actually eased somewhat this week. WTI crude is currently trading around $98 per barrel, while Brent crude remains near $105. In my view, those levels are manageable at least for the next couple of months. And by manageable, I mean the economy may continue slowing gradually, but not necessarily to the point where it breaks or falls into recession. Ultimately, much depends on how and when the Iran situation is resolved. Right now, this appears to continue to be a waiting game over which side can tolerate economic and political pressure longer. Unfortunately for the Iranian people, the regime's tolerance for pain appears significantly higher than our own. At the same time, there are increasingly signs that they may be approaching the limits of what they can endure. As always, we will continue monitoring developments closely. The next several weeks should provide a clearer picture regarding inflation, oil prices, consumer spending, and the overall direction of both the economy and markets for the rest of the year. Thanks for watching, and we'll keep you updated as conditions continue to evolve.